So to our program presenters for today, this month we will learn more about one of the hottest topics in our nation today, the fiscal cliff. Frank Hennessey of Premier Planning Group and Fred Hubler of Creative Capital Wealth Management Group will discuss what the fiscal cliff is and was, and what the government has and has not done about it thus far and what is on the horizon. So our first presenter is Frank Hennessey. He is a founding partner of Premier Planning Group, a wealth management and employee benefit firm headquartered right here in Phoenixville. Frank has an economics degree from Ursinus College and a chartered financial consultant designation from the American College. He is an investment advisor representative, a registered principal, a licensed insurance agent, and a fee-based advisor. Specializing in retirement planning and wealth transfer strategies, Frank is often asked to be a keynote speaker to other financial advisors throughout the United States. For 25 years now, Frank has considered it an awesome privilege and responsibility to be building relationships and building futures with his clients and their families. Please welcome Frank Hennessey.
Thank you. Thank you. Thanks, Joan Marie. Thanks, Jessica. If my colleague Mike Poland were here, I would thank him also for volunteering me to speak. That's what happens when you don't go to a meeting, you get volunteered to speak. Mike obviously respects my opinion on this subject enough to invite me, but not enough to actually come and listen to what I have to say. So thanks, Mike. It's good to be here with Fred, talking about a relevant topic, a timely topic, and one that I think we're going to continue to hear more about over the next few months, because it's certainly unfinished business. Now, the term fiscal cliff is not new. It's been bandied about for decades. I just read a reference to this term that was back in 1957, and it's usually a term talked about among politicians with reference to some type of budget crisis. Now, more recently, of course, the phrase is attributed to Fed Chairman Bernanke when he addressed Congress last February of 2012, warning them about some impending spending cuts and tax hikes that were built into the law. So this time around, the term fiscal cliff refers to the expected slowdown in the economy that could occur in 2013 because of these tax hikes and spending cuts. Let me say that again. I think it's worth repeating. The fiscal cliff this time around refers to the expected slowdown in the economy that could occur in 2013 because of the tax hikes and spending cuts. Now, when you add to that 24/7 news coverage, once again, we've got rampant speculation about our financial demise. And it really reminded me of the Y2K situation. You remember that? So I remind you, we've survived Y2K, and worse yet, 9/11 and the 2008 Great Recession. So the probability suggests that investors and consumers will live to see another day, fiscal cliff, partial cliff, or no cliff. But there are some specific things and concerns that are brought about by the cliff, both at a macroeconomic level and at a microeconomic level. Let me talk about a few of them here. So what I see is the three major concerns at the macroeconomic level. First is, most economists predicted that between the spending hikes or spending cuts and tax hikes, the economy would slow down enough to put us back into a full recession sometime during 2013. So that's number one. Number two is the unemployment rate is expected to rise at some point this year to over 9%. And number three, there's always the fear that as a nation we're going to receive another downgrade in our credit rating by the National Credit Services. Now, from a microeconomic standpoint, the three concerns that I see are the fact that there's a potential for taxpayers to have less disposable income because we're going to see more taxes on our income, on our investment gains, and on our inheritances. Second point is, there's been a lot of uncertainty with regard to family financial planning and estate planning issues. And thirdly, it's really caused a postponement of some major business hiring decisions and capital investment strategies. So in the 12th hour, there was a compromise. And that compromise is called the American Taxpayer Relief Act of 2012. And as many people expected, Congress partially addressed the issues, especially on the tax and revenue side. And this should effectively stall and lessen the impact of the cliff. Okay? So the question is, what did it accomplish? We'll go back to the macro and the micro. On the macroeconomic level, in my opinion, the compromise has accomplished nothing relative to what the real dilemma is. And that real dilemma is $17 trillion of federal debt and counting, not to mention tens of trillions of unfunded liabilities. Okay? So with some tax hikes that are expected to generate $600 billion over the next 10 years, on a macro scale, I don't think this has really accomplished much of anything. In my opinion, the focus should be not so much on taxes and spending, but it should be on economic growth. More jobs, rising wages, modest inflation. To me, that's going to go a long way to getting rid of the debt. That's the natural answer. That's the healthy answer. On a microeconomic level, I think this compromise has accomplished a lot, not the least of which is eliminating some of the uncertainty with taxes, especially on the estate planning side. So from the estate tax issue, there were many issues on the table, and here's what's been decided. The exemption amount, the amount that you're allowed to pass away with without incurring federal estate tax, has landed at $5 million for individuals and $10 million for couples. That number is indexed for inflation to 2011. Maybe more importantly is the portability of the unused exemption amounts between spouses has been made permanent. And that just makes estate planning a lot easier. The top tax rate has gone up from 35 to 40%, and the annual gift tax exclusion has gone up for 2013 from $13,000 to $14,000. So all in all, for what I'll call middle-class millionaires, this tax compromise was very kind and very generous. Now, as a practical matter, what does that mean for estate planning? And I would say that anyone who has postponed updating their estate plans because of this uncertainty, they should go to their attorney and get it done. Okay? Clarity has been established, and my advice is to communicate with your loved ones, communicate with your advisor, and become familiar with terms like disclaimers, beneficiary designations, trusts, and inherited IRAs. Okay? Now, as far as some of the other key tax provision, the takeaway is really this. Every wage earner is going to be paying more in taxes. Okay? Why is that? Well, the Social Security payroll tax is one. Okay? And if you're getting a paycheck this week, you'll probably see it in effect already. So for the last 2 years, the Social Security tax that we pay has been 4.2%. It's going back to 6.2% of income up to the Social Security wage base, which for 2013 is $113,700. So we'll all pay more tax there. And if you're self-employed, you'll pay double that, because remember, you pay both sides, the employer and the employee share. Okay? Now, in addition to that, for anybody earning, for an individual earning $200,000 or a couple earning over $250,000, the hospital portion of the FICA taxes is going to increase also from 1.45 to 2.35%. That's 90 basis points. And Sean, if I'm not mistaken, that's on all income, not just the Social Security wage base. All right, okay. Now, there's also, for those same income earners, there's a Medicare surtax of 3.8% on investment income. Those last little nuances, those two, by the way, are not necessarily part of the compromise, but they're to pay for health care reform. Okay? Now, as far as income taxes, the Bush-era tax cuts have been extended or made permanent for everyone except the wealthy, which has now been determined as individuals earning over $400,000 or couples earning $450,000. Okay, so those wealthy taxpayers will see their marginal rates increase from 35% to 39.6%. And they will also see an increase in taxes on capital gains and dividends from 15% to 20%. But for everyone else, their tax rates will stay the same. Okay? Now, there's more details on that if you didn't get all that. Fred and I each have a one-page handout. If you need more, I've got a 6-page something that I could email you. If you still need more, then call your local CPA. Okay, so the big picture is taxes are going up for everyone, but mostly for those with incomes over 400 if you're single, or 450 if you're a joint filer. So quickly, what can you do about it? Well, first thing is, I think you can expect to hear and see more hype and more drama. There's a lot of cliffhangers out there. It's unfinished business. We'll hear about debt ceiling and spending cuts, and what you want to remember is what we talked about a minute ago. They should be talking and focusing about economic growth. That's the natural way. That's the healthy way. So we'll hear more drama. Ignore it. Turn off the television. Most of it is irrelevant, okay? And plan ahead according to your life cycle needs. Get active and don't expect the government or your employer to take care of any meaningful savings and retirement strategies for you. Now, with respect to investing, cash, stocks, bonds, short-term, long-term, there are very subtle and specific things that you should be considering in light of the current economic, interest rate, and tax environment. Happy to get into those things with you at the Q&A or on a one-on-one session. I would certainly be more alert to tax-deferred and tax-free opportunities. The focus wants to be on not just return, but return after expenses and taxes. Or if you're retired, income after taxes and expenses. And if all of this sounds negative, it's not all that fun to listen to or talk to about, but there are some positive things out there. Take a look at the housing markets, okay, and how the housing market is recovering. Corporate profits are at an all-time high. They have cash balances that are extreme. Price-to-earning ratios are relatively inexpensive right now at about 13. And I'll tell you, historically, price-to-earnings ratios are a better indicator of where the market's going than politics. People, you know, stock prices react more to who's shopping and who's buying than they do about what Congress is doing or not. This month we've seen manufacturing numbers and retail numbers that look very promising. If you want to be really optimistic, you could suggest that there's going to be another boom, okay? Another baby boom or technology boom, and maybe it's oil and gas, and that's going to propel recovery in a healthy economy and an elimination of that federal debt that we talked about. So there's always reasons to be negative. There's always reasons to be optimistic. I try to keep a moderate ground. We don't know what they're going to do in Washington. We have no idea what the lawmakers are going to do. So I would suggest to you, you don't let politics or you don't let the media stand in the way of good planning. And you should implement sound strategies with your advisors or with your family members that work no matter what the case is. So to shed some more light on the topic, I'd like to ask Joy Marie to come back up and introduce Fred, please. Thank you.